Hello there, Lecture Series 15 on Bite-Sized Corporate Reporting is on IFRS 13 Fair Value Measurement. This is a three-part lecture series. The objective of IFRS 13 is to provide a definition of fair value, set out in a single IFRS a framework for measuring fair value, and set out the relevant disclosures about fair value measurements. The measurement and disclosure requirements of IFRS 13 does not apply to the following. 1. Share-based payment transactions within the scope of IFRS 2 share-based payment. 2. Leasing transactions accounted in accordance with IFRS 16 leases. 3. Measurements that have similarities to fair value but not fair value, such as value in use in IAS 36 impairment of assets and net realizable value in IAS 2 inventories. Additionally, the following are excluded from the disclosure requirements of IFRS 13. 1. Planned assets measured at fair value in accordance with IAS 19 employee benefits. 2. Retirement benefit plan investments measured at fair value in accordance with IAS 26 accounting and reporting by retirement benefit plans. 3. Assets for which recoverable amount is fair value less cost of disposal in accordance with IAS 36 impairment of assets. How does IFRS 13 define fair value? According to IFRS 13, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at measurement date. It is important to note the following. The phrase price received to sell an asset or paid to transfer a liability means IFRS 13 adopts an exit price measurement as fair value. Further, fair value measurement set out in IFRS 13 is market-based, not an entity-specific measurement. Moreover, fair value measurement in accordance with IFRS 13 is for a particular asset or liability and therefore should take into account the characteristics of the asset or liability that market participants would, such as condition and location of the asset and restrictions, if any. IFRS 13 does not specify the unit of account that should be used to measure fair value, and therefore the fair value measurement might be for either a standalone asset or liability, example a financial instrument or a non-financial asset, or a group of assets or liabilities, or a group of assets and liabilities, example a cash-generating unit. IFRS 13 fair value measurement assumes that the transaction to sell the asset or transfer the liability takes place either in the principal market for the asset or liability or in the absence of the principal market in the most advantageous market. The principal market is one with the greatest volume and level of activity for the asset or liability that can be accessed by the entity. The most advantageous market is one that maximizes the amount received to sell the asset or paid to transfer the liability. The second part of Lecture Series 15 on IFRS 13 Fair Value Measurement will focus further on the terminologies used in the definition of fair value. Till then, thank you and have a pleasant day.